Welcome to this explainer. Look, if you've been glancing at the upcoming financial calendar and feeling, a mild sense of panic, you are absolutely not alone. June is literally shaping up to be an absolute beast of a month for the markets. But hey, don't worry, because that's exactly why we're here today. We are going to take this totally chaotic June financial calendar and transform it into a crystal clear, week-by-week survival guide for your portfolio. We're going to cut through the noise, separate the signal, and look right at the hard data that's actually going to dictate market movements. So there's this quote floating around from our source material that I think perfectly captures the intense volatility we're about to decode together. It says, U.S. stocks this June are getting thrown into the washing machine on a spin cycle. Just think about that imagery for a second, right? We're talking unpredictable jolts, rapid, sudden changes in direction, and honestly, that feeling of having zero control if you aren't prepared. Market titans are going to be clashing, and massive amounts of institutional capital will be shifting right beneath our feet. Our goal today? To make sure you're not the one getting dizzy. Here is our roadmap for the month. We start with week 1, an AI reality check. Then week 2, inflation and hype. We brace for week 3, the danger zone. And finally, week 4, smart money shifts. Let's map this all out chronologically so you can see exactly how the density of these events just ramps up right in the middle of the month. Knowing this timeline is absolutely your best defense against those sudden, unexpected portfolio swings. Think of it like this. If you know an earthquake is scheduled, you don't go stand near the glass windows, right? Well, let's break down exactly what is happening in each of these critical windows so you can buckle in. Starting right out of the gate, we've got week 1 AI reality check. The entire focus right from the jump is on whether this whole AI boom is driven by pure emotional hype or cold, hard cash. And Broadcom's earnings act as the ultimate test of that narrative. On June 3rd, the whole market is going to be glued to this report. Why? Well, because Broadcom basically makes the networking chips that allow these massive AI server farms to actually talk to each other. They are literally the plumbing of the AI revolution. If Broadcom beats expectations, it proves that companies are shelling out real money to build out AI infrastructure. The party continues. But if they miss, man, it signals that all this spending might just be a mirage, and the entire AI sector is going to take a collective hit. It is a completely binary outcome. Wrapping up that first week on June 5th, we absolutely have to pay attention to non-farm payrolls, or NFP. Now, just to quickly define this, NFP is a key metric showing U.S. employment health, and it directly dictates the Federal Reserve's confidence for their future policies. This jobs data is the absolute baseline for the Fed's next moves. If the U.S. is adding a ton of jobs, the economy's running hot, which means the Fed might just keep interest rates high to cool things down. But if the job market is weakening, they might cut rates. Literally everything the Fed does is built on the foundation of this single metric. It's a critical hurdle before we even get to the second week. Moving right along to week 2, inflation and hype. Now, this is where the emotional roller coaster really starts to click up the tracks. Kicking off the week is Apple's WWDC, widely considered the final curtain call of the Tim Cook era. And let's be real here. Nobody actually cares what the physical new iPhone looks like. The only thing that matters right now is on-device AI. Can Siri actually become smart? Can Apple seamlessly integrate AI right into the phone in your pocket? If they pull it off and succeed, Apple leads the entire market charge higher. But if they fail, or if it's just, a mediocre update, the mockery continues, and a major pillar of market confidence is going to seriously wobble. Right smack in the middle of Apple's conference on June 10th, we hit our first super landmine of the month, the Consumer Price Index, or CPI. As a quick definition, CPI is a crucial inflation metric. A hot reading immediately crashes growth stocks, but cooling data fuels the market rally. This number will instantly make or break growth stocks. See, growth stocks rely heavily on the promise of future earnings, and high inflation just destroys the value of future money. If the reading is hot, meaning inflation is stubbornly high, expect growth stocks to just drop instantly. But if we see cooling data, oh man, that's the rocket fuel the market needs to keep dancing. Then, wrapping up week 2, we have the expected SpaceX IPO frenzy. Now, the crucial point here is to not get fooled by the hype. An IPO of this massive size is totally a double-edged sword. Yes, it triggers a massive retail investor frenzy for sure, but because it requires so much capital, it's actually going to drain liquidity out of other tech stocks. And even more dangerously, space concept stocks like Rocket Lab, AST SpaceMobile, and Intuitive Machines will likely see these massive, wild swings. But here's the kicker, they have absolutely zero business ties to SpaceX. Their price action is going to be driven purely by emotional, irrational hype. Seriously, if you have a weak heart, you might want to sit this one out. Which brings us to week 3, the danger zone. Okay, I need to be perfectly 100% clear here. Bridging the end of week 2 and the start of week 3 is what our sources accurately describe as the bullet flying zone. We are talking about June 10th to June 18th. This specific window is a period of peak, unexplained volatility. You absolutely, positively should not be chasing high positions right now. Having a heavy position in this window can literally get you wiped out by sudden, aggressive swings that honestly won't make any sense until after the fact.
So why is it so dangerous? Well, the threat here is really twofold. Step 1, we have the debut of the new Fed chairman, Warsh, right on June 16th and 17th. The market just doesn't know his temperament yet. Is he going to be strict, lenient? Every single word he utters and every dot on his interest rate dot plot is going to be scrutinized under a microscope. Then, literally the next day, on June 18th, step 2, we have to survive the bizarre volatility of an early quadruple witching. This is when a massive amount of options and derivatives all expire and settle on the exact same day. The trading volume is historically massive, and the volatility gets downright bizarre. Combine a brand new, unknown Fed chair with massive derivative settlements, you get pure, unadulterated chaos.
Finally, if your portfolio actually survives the boss fight, we arrive at week 4. Smart money shifts. June 24th serves as the ultimate final exam for the AI supply chain. We've got Jensen Huang's shareholder meeting paired up with Micron's earnings. Now, remember how Broadcom earlier in the month tested network spending? Well, this day tests the broader hardware and memory supply chain. It acts as a really crucial checkpoint, basically a final report card for the semester, right before institutional money steps in and makes its big end-of-month moves. And late June also brings a massive trap that you need to be aware of, the Russell Index reconstitution on June 26th. Once a year, the indexes that track small-cap stocks get completely rebuilt. What does this mean for you? It means a massive amount of institutional smart money is forced to rigidly adjust their positions, dictating the real price action on this exact day. So, if you see small caps suddenly skyrocket or plummet inexplicably around the 26th, whatever you do, do not try to analyze the fundamentals. Retail fundamental analysis is completely useless during these unexpected small cap swings. It's literally just institutions mechanically rebalancing their books. Stay calm and don't blindly follow the crowd. As we wrap up this explainer, I want to leave you with a critical question to help you evaluate your own risk tolerance before this roller coaster drops. With the titans clashing in June's washing machine market, is your portfolio buckled in, or is cash your best position? If you don't have the stomach or the liquidity for this bullet-flying zone, sometimes the absolute smartest trade you can make is just sitting back and watching the show. I really hope this roadmap helps you navigate the turbulence ahead. Stay sharp out there, keep your eyes on the data, and we will see you in the next explainer.